In this short video, we're going to talk about flips versus the BRRR model. Which model should you choose, or should you do both? Hi, my name is Mark Lloyd. I'm co-founder of Property Master Academy and been a property investor since 2005. So first of all, let's take a look at flips. What's the advantages of flips? Well, firstly, the biggest advantage is you get a cash lump sum at the end of it. Now, for a lot of people, by doing the flip strategy, that will give them their salary through one, maybe two deals, depending on where you are in the country. So that's a big incentive to do the flip model. And there's a great way of also building up your cash pot as well. So when you look at the profit that can be made on a flip project, you have to question, how long would it take to recoup that money if you were doing it through rental, through the BRRR model, which we'll talk about in a moment. It's going to be several years to get the same amount of money back. Now, if you're doing a flip, what I'm really talking about the flip here is a quick in and out. It's not something that's going to take you 6 months to do. It's really, we're looking at a quick turnaround, a 4 to 6 week project at the very most. That way you can turn around the money very, very quickly and should be able to get 2 to 3 flips done in a year. Now, if you can do that, for a lot of people, that's going to replace your salary. So it's a good way of giving you a great introduction to property, getting really involved in refurbishment and understanding the way property investment works, but also building your cash pot at the same time. And of course, another advantage of flips is it's much easier to work with investors as well, because they know that they're going to get their money back definitely when that property sells. Of course, one of the downsides is we have a change in the market and you can't then sell the property, so you've got to then adopt the BRRR model. So let's have a quick look at that, shall we? The BRRR model stands for buy, refurbish, rent, refinance. And the purpose of the BRRR model is to build long-term wealth, because by holding on to the property, that's where the true wealth is created. Now, you may have seen some statistics about properties in the UK that they on average double every 10 years. So you're buying your property today at £100,000. In 10 years' time, it should be worth at least £200,000. So you're building long-term passive wealth. Also, with the rental income, it's going to produce you a passive type of income. Now, it could be semi-passive, depends how involved you want to be. But if you employ a letting agent, for example, that's going to certainly reduce the amount of time you need to spend on a buy-to-let property, so it becomes more passive for you. The BRRR model also potentially gives you a faster exit than the flip model. So what do I mean by that? Well, although I said on the flip model you really want a quick turnaround, so you're looking to a 4 to 6 week turnaround of the project, but then of course you've got to try and sell it, and that could take 2 to 3 months to go through, sometimes longer. With the BRRR model, where you've bought the property, you've carried out the refurbishment, switching now onto a mortgage is actually relatively quick. That could be done within 2 to 3 weeks. So in terms of quicker turnaround, you're going to get your money back out much, much quicker. And in many instances, you may well get all of your cash back out on the BRRR model. But I would, a bit of a word of advice, don't necessarily expect it. You may hear a lot of people talking about the BRRR model as a way of using one deposit and recycling it several times. That can be done, but it is on the rare occasion in my experience, and I've been investing since 2005. Another advantage of the BRRR model, if you're buying in your own name, there is no capital gains tax when you refinance. It's because you're not actually selling the property. Whereas on the flip model, if you're buying in your own name, there will be capital gains tax or there will be corporation tax. On the BRRR model, regardless of whether it's in your own name or a company name, there is no tax to pay when you refinance. Now, how does this play out? Well, let's suppose you've bought a property for £100,000, you've spent £20,000 on it, and it's now worth £150,000, £160,000. You refinance, so you're going to finance up to 75% of the new value, and if we keep the figures simple, £160,000 as a value will give a mortgage of £120,000. Now that would be the ideal scenario because you're getting all your cash back out. But let's be a little bit conservative, £150,000, that means we're still going to have some capital left in the project, but that will have a substantially high return as well. As that property grows in value, so let's say in 5 years' time, it's gone from 150 to £225,000, you could potentially refinance again and pull more capital back out. Once again, there is no tax to pay in that scenario. So another advantage of the BRRR model. So when should you adopt the flip model and when should you adopt the BRRR model? Well, the flip model is a relatively quick way of helping you to get out of your job, because you're not relying on dribs of income coming through each month, which you could do with rental income. You're looking at large lump sums of money appearing 2 or 3 times a year. So it's a very good way of doing that. Of course, it's also a very good way of helping to build up your cash pot too. So, 2 really good advantages there. But when should you do the BRRR model? Well, the BRRR model works really, really well if you've got money to start with and you're not reliant on producing that pot of money. You've already got it to start with, so you can actually start to build your portfolio and you're not going to be reliant on additional sums of money. So by doing the BRRR model, you're going to start building a rental portfolio and longer term wealth that much quicker. But of course, don't forget, rental income is much, much less, of course, than the flip profits. So it's going to take a long time to build up that rental income, but you are starting to create that wealth much earlier because you're retaining the property. And of course, another reason to do BRRR model is if your priority is passive income. You don't need those lump sums. So hopefully that gives you an idea, but what if you could do the 2 together? See, my suggestion would be, for every 3 properties that you buy, keep 2 and flip 1. That way you're building your portfolio, but you're also creating cash lump sums too. So which model do you use? Do you use the flip model? Do you use the BRRR model? Do you use a combination of both? Let me know in the comments below. I'd love to hear from you. I hope you found this video useful. If you have, please hit the subscribe button and the notification bell at the top of the screen so that you get notified as and when other videos appear. There should be some other videos appearing on your screen right now that we've done previously, and they will help you progress in your property journey.